Hello, America. I'm Camille Chandler, and this is Qualitative Listening. Today's headline: Global Economic Turmoil Continues. Let's start with the Treasury yields. The 3 month is at 4.32%. The 6 month is at 4.20%. The 2 year is at 3.78%. The 5 year is at 3.9%. The popular 10 year is at 4.3%, and the 30 year is at 4.8%. Let's take a look at global and domestic macroeconomics. In Europe, the European Central Bank announced a 25 basis point reduction in its key interest rate, bringing it down to 2.25%. This marks the seventh rate cut within the past year, reflecting the ECB's efforts to support the Eurozone economy amid challenges such as weak growth, rising U.S tariffs, and diminished business confidence. The decision was unanimously supported by the ECB's governing council, including traditionally hawkish members, due to heightened economic uncertainty and lowered growth and inflation expectations. The ECB noted that these factors, along with increased market volatility, are likely to negatively impact financial conditions and economic expectations across the Eurozone. Despite the rate now being at the upper end of the ECB's estimated neutral range, policymakers have minimized the importance of this threshold. While financial markets anticipate further rate cuts later this year, the ECB has signaled a cautious approach, indicating that future decisions will be based on incoming economic in the U.S. Let's take a look in the U.S. Macroeconomic landscape is marked by escalating trade tensions, inflationary pressures, and cautious monetary policy stances. Here's an overview of the current economic conditions. Monetary policy and inflation. The Federal Reserve stance maintains a hawkish position, signaling a prolonged hold on interest rate adjustments to manage inflation risk, driven by ongoing trade tensions. Fed Chair Jerome Powell emphasized that trade tariffs could cause persistent inflation, dismissing expectations of immediate rate cuts despite a tech-led market downturn. Let's look at the inflation outlook. Economists forecast that core inflation will remain above the Fed's 2% target until at least 2025, limiting the central bank's ability to implement more than two interest rate cuts by year end. Looking at economic growth and recession risk. GDP growth projections for 2025 have been downgraded from 2.2% to 1.4%, marking the steepest monthly revision since July 2022. Recession probability. The chance of a U.S. recession in the next 12 months has increased to 45%, up from 25% last month, according to a Reuters poll of economists. Now, let's turn to the housing and construction market. Building permits. Preliminary data for March indicates that U.S. building permits rose to 1.4 million units, slightly above the previous month's 1.45 million, and surpassing the consensus forecast of 1.4 million. What are the global trade and market reactions to everything I just previously mentioned? The aggressive U.S. tariff policy is projected to cause a sharp economic slowdown with significant repercussions for global trade. The World Trade Organization warns that these tariffs could reverse global trade growth, lowering its forecast from plus 2.7% to a negative 0.2% decline. Market volatility. Global financial markets experienced turmoil following tightened U.S. export restrictions on chips to China, causing sharp declines in global stocks and the U.S. dollar. Gold surged to a record high above $3,300 an ounce amid growing investor uncertainty. That's the show, folks. Thanks for listening to Qualitative Listening.